Picture an ETF like a factory line for turning stocks into tradable shares. The parts move in, the shares move out, and the key operator is the authorized participant. They are the engine that keeps ETF prices on track. Authorized participants are large banks and trading firms with legal agreements to transact with the issuer. Think Goldman Sachs, JP Morgan, or specialist market makers like Jane Street. Regular investors cannot create or redeem ETF shares directly with the fund company. EPs are the bridge between the exchange where you trade and the issuer that holds the portfolio. Unlike mutual funds, APs usually do not send cash. They deliver a precise stock bundle in kind, and they trade in huge blocks called creation units, typically 25 to 100,000 shares. When demand is high, the ETF price lifts above its net asset value. The AP buys the underlying stocks in the correct weights. They deliver that stock bundle to the ETF issuer. The issuer creates a new creation unit and hands it back to the AP. The AP sells those ETF shares into the market, increasing supply and cooling the price. When demand is low and the price falls, the loop reverses. The AP buys ETF shares until it has a full creation unit. They redeem those shares with the issuer and receive the stock bundle. Selling those stocks removes ETF shares from supply and supports the price. This is arbitrage, not charity. If the ETF trades at 101 while the stocks are worth 100, the AP creates shares and sells the premium. That selling pressure pushes the ETF price back down toward 90. If the ETF trades at 99, the AP buys the ETF, redeems it, and sells the stocks for 100. That buying pressure pulls the ETF price back up toward its value. The result is better liquidity. Even if the ETF itself is lightly traded, prices stay tightly aligned with the net asset value of the portfolio, and in-kind swaps help avoid capital gains taxes inside the fund. So APs keep ETFs liquid, accurate, and tax efficient.